Hi, I'd like to take this moment to introduce everybody. I have with me three other individuals, Adam Dekker, Jeremy Tims, and David Brown. Adam is the enrolled agent that works with Dekker Financial Services and has been our junior advisor for quite a few years, and he is moving up to the senior advisor role very quickly. That won't be long, but that's a future call. We also have with us Jeremy Tims. Jeremy is from Sioux Falls, South Dakota. He's a CFP and a passionate leader. He brings a different eye and a different perspective to the table because of his location, first of all, a lot with the farming community and has a love for seeing financial plans, families, and planners come together. We also have David Brown. David Brown is an attorney in Chandler, Arizona, and he has had over 25 years experience, and works in a wide range of areas, but he provides legal representation for real estate matters. And we are all going to discuss different factors. I'm Meredith Dekker, a chartered financial consultant and senior advisor at Dekker Financial Services. And we'd just like to welcome all of you to this. We want to make sure that everybody is aware that this is an educational video. We are not giving financial advice at this time, and we would ask that you please consult your financial advisor to receive that financial advice and tax advice that you so urgently need.
So this is not legal advice. This is only for educational purposes. There's no attorney-client relation established here.
Correct. I look forward to what you all have to say, and I'm excited to get started. Jeremy, I just want to find out a little bit from you is how has the COVID-19 affected your financial practice, and what are some highlights and points that you would like to bring to the table for us today?
Well, I think number one, it's having an effect on everybody's business today. I think it's pushing us a little bit more to using this technology that we use every day. It's good that we've had some of it in place and have had some introduction to it up to this point. Makes that a little bit easier to take that leap to now use it almost full time. The last couple weeks now, I'm going to actually gather some of my first clients that I've had in my career, where I probably won't meet them face to face before we start working together. So, just glad for technology, glad for the ability to keep working through this time. So, with that, today I was just going to try to spend some time talking about 8 different things that I've been talking to my clients about during this time, during what we would term the COVID-19 pandemic time. So really just 8 different things that I think we can highlight. I'll go through those over the next few minutes, and if there's questions, make sure the three of you, stop and ask me.
Definitely.
Number one, I think the most important is to determine, for all my clients, are they still on the right track? It's a stressful time. There's uncertainty over both jobs and finances, obviously, when it comes to this, in addition to everybody's health. It's a great time to, maybe if you have a little bit more time working from home, to reevaluate and connect with your current advisors. They also have a little bit more time. I think everybody's a little bit more efficient today than they normally would be. It's also a good time, again, just to reevaluate and prioritize your planning, see if you're on the right track and if there's needs to be adjustments made. That's number one. Number two is obviously with that, readjusting any budgetary concerns. Now, the disadvantages is we don't get to do all the things we want to do, but that means no eating out, not as much unless we're, doing pickup or carry out. We don't have near as much entertainment, and we're not traveling as much. So those 3 things are pretty big items typically within our budgets that we can reevaluate and look at and probably find ways to alter our budget and save. I think the keys, though, with that is not only to find the temporary things, but finding the permanent things, the small permanent things that we can do within our budget to change. Those are the things that are going to have a lasting effect long term. So it's a balancing act. You want to do a little bit of both. You got to make some concessions today immediately for what's going on, but you also have to make some budgetary changes that are going to have a long-term impact. For the people that have your IRAs out there and your investments, it's a great time to look at converting to a Roth IRA. We've seen a pullback in the market. I went through this in my practice when we went through 08 and 09, when we had the mortgage pullback in the market. It's a balancing act of today's income tax rate versus tomorrow's income tax rate. It's the amount of dollars in those accounts, and it's over the time in which we will utilize those funds. So those three factors to that, but it can be a great time because we've had a pullback of somewhere between 15 and 25% for most accounts. And because of that, it's a great time to pay tax on less dollars. So I encourage everybody to take a look at that, see what can be done. If you believe the market's going to still...
Jeremy, there you go. We lost your video. It froze up there for a minute. Okay, I think we're back. Yep, I think we're back.
If you believe the market, if you believe the market's still going to downturn from here, you could also do a partial conversion today and leave yourself a portion to do later as well. So you can spread that out if you want. It's also a great time to, again, with that budgeting that I talked about previously, I would say my number 4 is create a game plan if your emergency reserve would run out. Housing prices, if you own a home, have still remained strong. And if you're working from home, you still have an income. So it's a great time to look at, getting a HELOC in place that maybe you wouldn't use today, but you might need to lean on if there's a time period where you get laid off. With the budgeting and with, looking at that emergency reserve, I think make sure that number 5 would be consider reducing and eliminating payments. There's many credit card companies, banks, places like that are willing to work with people through this time. Make sure that you call them. I think Adam will be talking a little later here about student loans, but student loan payments, some of those don't need to be made now. State of New York people don't even have to make mortgage payments right now. So I think it's a good time to look at those, work with your lenders, make sure that they know what your difficulty is and see what options you have. Make those phone calls now. Many of the college, so my number 6 then is moving on to college stuff. If you had kids at college and you used 529 money, it's a great time to, many of those students are getting refunds of either tuition or room and board. I think if they got refunds on that and it was paid from a 529, that money can be rolled over back into those 529 accounts within 60 days. So make sure you're looking to take advantage of that. Don't know when you'll need that next based on hopefully by fall we're back to normal and everybody's back in school.
Jeremy, can I ask you a question on that? If they do not roll back, or put the money back in a 529 plan, and the university has refunded that money, are there consequences to that?
Yeah, there would be both tax and a 10% penalty, I would assume, in filing the taxes, because the college is not going to show that as money paid to the college, and you're going to show that as a distribution from your 529 plan. So those two forms are not going to match up on your taxes correctly. So there would be more tax to pay than you'd probably be planning for. So that's why it's important to make sure that money gets rolled back in. Good question. Number 7, I think just overall looking at all your retirement accounts, your IRAs, your Roths, and your investment accounts for risk. I think sometimes our risk perspective can change during these times. It's always easy to say I can handle a 20% pullback. Times like these change that perspective changes. So I think it's a good time to look at that overall allocation. Now, that being said, I think it's time to be cautious about reallocating to something more conservative right now. That maybe means, hey, we got to hang on through this downturn. We got to hang on until things recover, and then we get more conservative going forward so that we don't have to deal with this in the same way that we dealt with it this time. And we don't see that drawdown as far down as we did this time. And then number 8, I think my final point is obviously, as we tell all of our clients, time to revisit those healthcare directives, financial directives, and those living wills. I think that's always good practice every few years as life continues to change. But one of the things that's come up through this is there's many people that have that have healthcare directives in their documents that say they want to have no means of artificial life support. And obviously during COVID, something means a little bit different because a ventilator is something that is artificial life support. So you want to make sure that you have the proper documents in place and that they say the things you want to have actually happen, and it's not just boilerplate language out there. So make sure that you have those, you revisit them, and that the proper people in your family have a copy of those to access during this time.
That's right. That's very good.
So that's kind of an overview of 8 things we've been talking to people here about. There's obviously many more, but I hope that maybe sparks some summary and talk that people can have on their finances.
Right. And I think it's important to remember also that the people that are not, that are taking withdrawals from their paychecks and that kind of thing and withholding taxes, that this year may be a little bit different. It may be a year where they don't have to withhold as much taxes and that type of thing in order to help ease some of that cash flow burden possibly over the next couple months.
Yeah, so obviously reassessing a W-4 or something, doing an income tax summary is always a good thing. Estimate, seeing where that stuff's going to land. There may be excess hours you can use today rather than waiting for that
right.
refund at the end of the year.
Very true. David, you have extensive knowledge, obviously, in the mortgage industry and what's happening out there, and you've also done some estate planning, also that you could maybe expound upon what Jeremy was talking about. But tell us a little bit about how the COVID virus is affecting the real estate market and what you're seeing on the forefront of things.
Well, in Arizona, we were dealing mostly with what we would consider the mortgage forbearances, where they're not, I think up to 120 days, you have a forbearance period where you don't have to make that monthly payment into your mortgage payment. However, when that ends, you have to deal with that. So that becomes a little bit touchy and tricky, and that really depends on how each lender is going to treat that. Are they going to offer modifications? What are they going to do once that happens? I think that will definitely be an interesting time, and those 4 months are, of course, approaching rapidly. We have, I look at it in terms of 2 different lanes that we're dealing with the COVID-19 ramifications. In terms of business, I see as things reopen, business owners have to be very careful. They have to take preventative measures to protect their clients or their staff. And they have to be very careful with that because of tort liability. And there's some discussion right now in the Senate about limiting liability to businesses once they reopen. But none of it, there's no limitation of liability if you do not follow the government health guidelines. So you have to be very careful with that because somebody comes in, they can trace it back to your business or the visit to you where they have become ill, or heaven forbid they become ill and they die. You have significant tort liability. So you have to be very careful with that as things loosen up. And things are going to loosen up pretty quickly.
David, where would they find those guidelines?
Well, the government guidelines are the ones out by the CDC, the Health and Human Services, the things that we know about. And you see when you go to the grocery right now, you see them out there with where they're for example, some are taken it to the extreme, like Costco saying you can't come into a Costco as of today, effective today, if you aren't wearing a mask. They're strictly enforcing the 6-foot distancing. They have to protect their employees. They've put up the plexiglass. They don't touch your Costco card, those types of things. Well, the same thing applies. If I'm notarizing somebody's documents this afternoon, I am wearing gloves. I'm wearing the mask. I am before I obviously have to go over documents with them. It's almost impossible to do distancing with them when you do that. But I'm taking every precaution in between that. I'm not requiring them to wear a mask yet, but I will be requiring them to wear a mask soon once things loosen up. Once they come in the office, they have to wear a mask. In the conference room, I have disinfecting wipes, disinfectants. I wipe down all cards and things like that I take from them and I give back to them. I take every preventative measure I possibly can to do that. I might go as far as to have them sign a disclaimer saying, hey, look, they understand that this particular transaction we're doing is going to infringe on social distancing. It's going to be impossible for us to remain 6 feet apart. And you understand that. But remember, in Arizona, which is a little bit different, there is no assumption of risk like that for tort liability. You have to specifically say in a waiver, hey, you understand that you are waiving your right for social distancing. It can lead to health, to sickness or to death.
Put a warning on, like the Surgeon General's warning on cigarettes, right?
Exactly. So those are the types of things that we have to keep in mind specifically to Arizona. Then for businesses, lots of businesses are taking out the PPP loans. And they take out these PPP loans. Well, at 8 weeks now, from the time that the loan was, you have to start the repayment process if you want to have the loan forgiveness versus the loan repayment. And remember, depending on the size of your business, that loan payment could be humongous. So, because you're repaying the loan, even though the interest rate is only 1%, you're repaying it in 2 years. So that actual payment could be significant. So, for example, you have a loan about $80,000 a month. You're paying $5,000 back a month to repay that loan in 2 years, unless you take the necessary steps to have the loan forgiveness done, and that's a careful understanding of the CARES Act.
Right. I think that's one of the issues that have not been addressed is how many people do not understand that they have to actually do something in order for that loan to be forgiven.
In 8 weeks from the funding.
Yes.
Not just tonight. And then, of course, some businesses are just going to have to seek protection. And luckily, and it's all sort of all happened, somehow things work work out for us in ways when we don't plan it. As of December of last year, we have what I would call a poor man's Chapter 11, where I can do a Chapter 13, a reorganization for businesses under Chapter 13 of the bankruptcy plan, which is way cheaper, way less extensive. If you come to me and say you want to do a Chapter 11, first of all, I'm not doing it, because most of my clients can't afford it. But a minimum Chapter 11, we're looking at $25,000 in attorney's fees, minimum. And that's that's a cheap Chapter 11. But in the Chapter 13, we can help businesses and save them, because you have to remember, once all of these forbearances end, the forbearance on landlords evicting business tenants, all of those things. If you don't have the income, if you don't have the revenue, you have to seek reorganization or your business will collapse.
David, why don't you explain just in one sentence, maybe each, what the difference between a Chapter 11 and Chapter 13 may be for our audience?
Oh, okay. Well, when you think of Chapter 11s, you're really thinking of a reorganizational plan for a large business where you come in, you reorganize some of your debts, and others are discharged. You come up with a plan. It's a very short, well, it should be a very short period. You come up with a plan. Once that plan goes into effect, some creditors are discharged and some creditors are paid. But the idea of the reorganization is to protect those creditors. We have classes of creditors, and those classes have to join in. When we think of a Chapter 13, we're normally thinking of a consumer, an individual, a family, filing a bankruptcy and doing a reorganization. Very similar, you have classes of creditors, and they are paid based upon what income there is to put into the plan. Now you can extend that Chapter 13 type plan to a small business. And that's relatively new. When I say very new, it's about 4 months old. Well, yes, it's May now, so it's 5 months old. And it's going to save a lot of businesses. On the flip side, for individuals, if you go back to what we were just discussing, estate planning is critical. If you don't have your estate planning in place, you've got to do it. Not just for the idea of you passing away and having your estate distributed to your beneficiaries, but the other part of estate planning. If you're doing a complete package, you should be doing a durable financial power of attorney. And what that means is, for the individual, if you're ill, if you cannot function, that durable power of attorney will remain in effect, and the person or persons that you designate can handle your business activities without having to go to court and getting a conservatorship, which is costly. It takes time, and sometimes the court may say, no, the people that you choose are not appropriate for as your conservator, and that's the last thing you want. You want to be in control. Who is it that you want to manage your money? I want Adam to manage my money if I can't manage it. You know what I mean? I don't want some stranger that I don't know to do it. Same thing with the living will, as you touched on a few minutes ago. Without that living will, you may have issues as to what is done and what is not done with you. Medical powers of attorney. Again, many of these COVID patients, they reach a certain point where they can no longer make medical decisions. You need to have that power of attorney in place so you aren't running to court to try to get a guardianship to make a decision on what to do with that person. And lastly, and I know this may seem crazy, but if you look at New York, we have remains that are unclaimed. We have remains where people don't know what to do with them. And if you have your end of life decisions in place, and you've already done your planning, so you've purchased the place where you want your remains to be, you've decided if you're going to be cremated or buried, those types of things, and you fund it. You actually go on and make those payments. When that time comes, that document is going to stand there, and that's going to say what to do with your remains. This is going to sound really gory, but I have a box of ashes at the front desk right now in my office that I have to determine. I'm seeking a family to get it to. And if I can't, it's going to go to the county and it's going to be buried in the potter's field. That's where it's going to go. So here's somebody, I know they've purchased a plot in Tucson. I know that, but I have no one to give it to.
Wow. That is an aspect of this that I've never even thought of.
Oh yeah, Adam, you can come by and take a look at those ashes, and the guy's dog's ashes are there too. What am I going to do with this dog's ashes?
I am glad you have your sign on your door yet, no entrance.
Well, anyway, I didn't mean to end in such a gory, but my point is, there are a couple of other things I didn't touch on. If I have a minute more, Meredith, if I may.
You bet, yes.
For consumers, if in fact the mortgage, the real estate market does not hold up, I'm hoping that we can prevent the short sale fiasco that we had last time. And to me, that was the biggest driver of the collapse of the values here in Arizona, where people said, hey, look, I can't afford this house, and it does not make sense keeping it because I can't afford it. And they were letting them go. And as they let them go, the values dropped.
Right.
As the more and more became available. In Chapter 13 bankruptcies, now we have a mortgage modification mediation program, which is a court-supervised program that actually has a portal where documents are loaded up, so we don't have all those issues with lenders saying, I lost your documents, I can't find this, I can't find that. That's all in there. We have a mediator that says, hey, look, lender, you're crazy, this loan should be modified. Ultimately, if the modification terms aren't good, or if the modification is denied, we have a judge that we can go to and say, hey, Your Honor, these lenders are not acting in good faith. Please, send them back to the table to deal with this. And that's relatively new, but it's there and it's available in Arizona and we can help people save houses and save their homes so we don't have the collapse in value that we had before. Obviously,
if I may,
I'm not going to be able to get to today, but tax liabilities, income tax, landlord issues, those types of things that are going to that will all come up as a result of these things. Maybe the next
one. I believe you had a question?
Yeah, one quick question. So about those loan modifications, at what point should they reach out to begin that process? I know now there's a... Go ahead.
Well, go ahead, Adam.
I was going to say, I know there is, some forbearance and that kind of thing going on now, but at how long does that process take? Should they wait till a payment has been missed? When does that start?
I think once you determine that your income is not going to be reestablished, as long as you realize, hey, look, I cannot say that come June or July, I'm going to be able to make these payments. I would not wait until the forbearance is over. I could get you in that program, and we can. So how it would work would be like this. I would say somebody comes into me and they have a car that they're paying on. They have a loan that's in arrears. Unfortunately, they have some unpaid income tax. And then they have not paid their credit card bills because they've been laid off. Okay, but they want to keep their house, they want to keep their car, and they want to deal with the IRS. I can seek to modify the loan and work those arrears in, keep them in a Chapter 13 to protect them from foreclosure. If the car is more than 2.5 years old, I can reduce that car loan down to the actual market value. So so you bought that Hyundai. It was very, very, very nice deal when you bought it, but you owe $16,000 on the Hyundai, but it's only worth $11,000. And if that loan is 2.5 years old, well, you only have to pay back the $11,000. Okay? And you're paying the prime plus 1 point when I cram down the interest rate. So that I can reduce the interest rate on that as well as the value on that. Then those taxes that you're behind on, you'd only pay the priority part of it, which would be the actual principal. The penalty and the interest on the penalty are thrown into another group of class of creditors that where your credit cards and hospital bills and everything else will fall into. Throw them in that, and those will get discharged at the end of the 5-year period. So at the end of the 5-year period, you walk out with a modified loan, car paid off because your car is going to be paid off in full, taxes resolved, and credit cards discharged, and the penalty and the interest on the penalty discharged in that. So I can take somebody who is in complete crisis now, reduce those things that they want to keep to an affordable amount, and at the end have them come out without a bunch of debt.
That's great. That's good. Helps them with a new start and turning things around.
It's a clean slate.
Yeah.
I forgot something really important. SBA loans. SBA loans right now, if you have an SBA loan, you should not be making monthly payments. And if you do make monthly payments, they should be going towards your principal reduction. Because right now, for the next 6 months, the government is going to be making your monthly loan payments on SBA loans. So that's
and on an SBA loan, to clarify, there are some loans that are partially funded by the bank and partially funded by SBA, correct?
Correct. The ones that are funded by SBA, the government is making all of those payments for the next 6 months. And you can make a regular monthly payment, just have them apply it to principal reduction.
Okay.
So you could double up on your payment if you wanted to pay that down right now.
All right. Okay. That's
Okay.
good. Adam, fill us in a little bit about the student loans and what's happening there.
Yes, I do have a few points to share about student loans. As we were talking, got me reminded about taxes a little bit before we get there. Just a reminder that federal and state income taxes the personal filing date has been pushed back till July 15th. So that gives you more time to file and more time to pay without any interest or penalties building up. Now, you may want to file before that for different reasons. For example, if you file your 2019 returns, that may give you eligibility for the stimulus checks. Whereas, maybe 2018 you didn't qualify, but 2019 you do. That is a good reason to file now instead of waiting till July 15. Also, if you're expecting a refund, you want to file now. There's no reason to wait till July 15. But if you do owe a balance, keep in mind you do have until July 15 to pay that. And so that may give you a little bit of flexibility about, if you're trying to choose what liabilities and what bills to pay, you've got until July 15 to pay your tax returns. Most states have followed along with the federal regulation, but not all states. So if you're watching in a different state, keep that in mind just to check with your state tax advisor. But yeah, student loans. So as a millennial, obviously this is a subject I'm very familiar with. So a lot of relief was passed for student loans specifically, as opposed to, credit cards and that kind of thing in the CARES Act. And the biggest thing is that federally owned and federally held student loans have been put in an automatic forbearance where there's no interest building up and no payments due until September 30th, 2020. So keep in mind there's 2 qualifications. It has to be a federal loan. So if you refinanced with Wells Fargo or SoFi or somebody like that, that's not a federal loan anymore. That's a private loan. And the other thing is it has to be federally held, where you may have what's called a federal family education loan that's held by a private lender. Those do not qualify. But if your loan does qualify, you don't have to do anything. All you have to do, what I would absolutely recommend for everybody, is to log online to your lending portal and verify that those payments have been put into suspension with 0% interest. The balance that you had today should be your balance on September 30. No interest, and that doesn't capitalize. Now, if your loan doesn't fall into one of those categories, what can you do? Well, if you've got federal loans, but they're not federally held, you may want to look into whether or not you can consolidate those loans into a loan that does qualify for a suspension. The Federal Department of Education, they do offer loan consolidation programs where you can consolidate your federal loans. And so that's one thing you may want to look into to see if, hey, I don't qualify now, but I can consolidate into a different type of loan and get that suspension. Now, if you have private loans, if you like I said, Wells Fargo, SoFi, somebody like that, Sally Mae, you do not have the same options that were passed in the CARES Act. But the number one thing you should do if you're concerned about being able to make your payments is reach out to your lender. Don't wait until you can't make the payment. Be proactive, because you don't know what they all have freedom to set their own terms here. They can say, oh, we're giving all these people automatic forbearance or something like that. You may be eligible for an income-driven or an income-based repayment plan where, if you lost your job, you can either apply for one of those programs or recertify your income where you could lower your payment. Now, one thing to keep in mind, and I say this to everybody, in good times and bad, is the thing to be aware of with those loans, the income-driven and income-based, is that the interest that you don't pay gets capitalized onto your principal. And a lot of people are like, oh, I'm, hardly paying anything for my student loans. It's on an income-driven plan, but what they're not realizing is their principal is going up year over year because that unpaid interest gets capitalized. So always make sure you fully understand the terms of your loan and that, is that interest going to be capitalized or is it not? Now, I have heard that in some cases, due to the CARES Act, some lenders are not capitalizing that interest. But again, be sure to talk to your financial advisor, talk to your lender directly, see what they are offering specifically. And then the last thing I want to point out is collection efforts have been paused until September 30th. So, if you were already in default, those collection efforts should be paused until September 30. I'm talking like garnishment of wages and that kind of thing. So if you are in trouble, again, reach out to your lender, make sure you understand the terms of your loan and talk to them to find out exactly what solutions they're offering and what they can do. Usually they want to get the loans paid. They don't just want to, collect on wages because they don't get paid as much. So work with them, figure out what your options are. If you're on a track for public student loan forgiveness, if you're on the program where, you work for a qualifying agency for a certain period of time, like government or teachers in a low income district, that kind of thing. If your loan goes into the suspension, as a federal loan goes into suspension, that counts toward your repayment period. Usually you have to make 120 qualifying payments or whatever. That counts. Even though you're not making the payment, this suspension counts toward that period.
Oh, that's good to know. Very important to know. Well, I was going to talk a little bit about 401ks and the COVID virus and how the CARES Act has made some changes there. One of the things that is, I'm going to change my view here a minute. One of the things that is, I'm not showing up on the screen here. One of the things that has been, I don't know.
We can see you.
You can see me? Okay. All right. One of the things that people have been asking about is what's happening with 401ks, and I heard I could get all my money out without any penalty. Well, I just wanted to recap of what that was. So first of all, if you have left an employer and you are no longer employed somewhere and you had a 401k, be sure to move that 401k over to, if you want to move it, you don't have to move it, but if you're not going to manage it at the employer, then be sure to manage it yourself or move it over to another under somebody's management at a financial advisor, and talk to a financial advisor about that. But do not leave the 401k and then go to another employer, leave another 401k, and have all these little 401ks all over. I mean, that is your option. However, it is an estate nightmare. And it is also very difficult to manage and know how you're invested, where that money is, and to make sure that you're all invested into the risk tolerance that you can stand. So if you can only stand risk tolerance level on a scale of 1 to 10, say a 6 or a 7, and you've got everything in bonds in one and you're all equity in another, and then you wonder why that one that's in equity just dropped by a big chunk of money. So there's all these determinations that should be made, but don't forget about that 401k at your old employer. The second thing is you can move with the CARES Act. You can take some money out of your 401k if, and there's a lot of ifs. First of all, the employer has to make these changes in their plan in order to accept some type of distribution or a loan that's based on that 401k. If the plan documents do not allow it, then there really isn't anything that you can do if the employer is not willing to make those changes. Most of the third-party administrators that the employers are working with are volunteering to make those changes for the employer, but that is not with every third-party administrator. The second thing is now you can borrow up to $100,000 or 50% of your 401k, whereas before you could only borrow $50,000 or up to 50% of your 401k. So there's two ways that you can get some relief, and that would be either by a loan from your 401k or by a withdrawal. A withdrawal, it means that you have the intention of not paying this back. Now, that you have to be, if you're going to take the withdrawal and you are under the age of 59 and a half, typically you would get a 10% penalty. However, if you have been affected by the COVID virus, either that you have the virus yourself, a family member has the virus and you need to care for them, or you have a financial hardship because you were laid off because of the virus or something like that, you can qualify, if your employer allows it, to take money from the 401k. Those qualifications are determined usually by your employer. You would go to your HR person, you would tell them and verify what the situation was, and then you could also make that requirement. Now, there are a whole bunch of issues of what I just said about going to your employer and having your employer verify a medical situation, which is totally against HIPAA rules. So I don't know how the government's going to deal with that, but that's one of the requirements. I'll let them worry about that. So if you do take a withdrawal, and there are certain situations, let's just say that your spouse lost their job, you need to take money out in order to make ends meet. So if you take that money out, you then have an option of returning it, or you can keep it out and pay the taxes on it. Now, if your spouse has lost their job and you are in a lower tax bracket, and I'm not talking about the penalty here, I'm talking about just the taxes, maybe it wouldn't be a bad idea not to repay it if you were a person that was disciplined enough to put that money away strictly for retirement. This will reduce your required minimum distribution when you're at 72. Now the age is age 72. So there's a lot of benefits that you may be able to take advantage of, but you need to talk to a financial advisor to figure out what is the correct way for yourself. if you do take money out and you want to pay it back, it needs to be paid back within 3 years. So for instance, let's just say you took out $9,000, then you could pay back $3,000 each year, and only $3,000 would be added to your income. So every time you take money out of 401k, that is added to what you're earning. So even if you earn $100,000 in the year and you take out 9,000, then 3,000 of that will be added to your income base. So you'll be basically at 103,000. And then the next year you take the next 3,000 and you'll pay taxes on that. And the third year you will pay the taxes on that. So the years go from 2020, 2021, and 2022. At the December of 2022, you need to have that money paid back or paid the taxes on that money. So it may be advisable for you to take a loan or a distribution, but that is one of the things that you really need to talk to a financial advisor about. So that was my biggest points, and I wanted to make sure that I was able to squeeze that in our limited amount of time. But does anybody have any questions?
I do have a question for you.
Yes.
Has there been any changes about for 2020 about the required minimum distribution?
As far as I know, that has been delayed, that you do not have to take the required minimum distribution for 2020. And that is a fact that I have not researched that for this call, but I believe that that's what the law was.
So Meredith, somebody comes to me and they are in distress. My first question to them should be, do you have a 401k or retirement plan? If so, go see your financial advisor to determine whether or not
Correct.
you will be able to borrow or withdraw from that under the CARES Act and so on. So that's really important for them to be looking at before they make decisions.
Yes, and there's so many ifs about that. If this, then you can do that, and if this, you can do that. So yes, definitely one of those decisions. Yes,
they clearly need to see a financial advisor. That's not something that they should be trying to determine that on themselves.
No, that they will be paying a price probably for going there, without the knowledge of the full consequences. Yes, uneducated. Thank you.
And these are the times when it's so important to make sure that, like you said, why it's so important to roll stuff out of an employer plan and partner with an advisor is when we do get into times like these, you can have somebody to support that and help you make those decisions.
Correct. Absolutely. Well, thank you all for joining us today. We're at the end of our call, and I hope you found this educational, and we hopefully will do more coming forward, but we felt this was some information that you needed to be sharing with you, and I want to say thank you very much. We will be providing our contact information for each of us, and you will be available to email or call any one of us. Thank you very much and have a great day.